Hello, everyone, and welcome to tonight's session of TradeFinder Live. My name is Zach. I'm one of the team here at EWO Options, and I'll be facilitating this session tonight with our speaker, Rob Roy. I'll introduce Rob here in just a few moments, but first we need to cover off a few important details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've seen any of our live sessions previously, whether it be a TradeFinder live session or insiders meeting, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing needs to be taken as personal investment advice. We do have this available on our website to be read in full detail there, or feel free to take a screenshot if you like, but that's the main point to take away. So for this session, as you'll see on the screen, we just have one method for asking questions, and that's going to be through the Q&A window. The question portion is a bit brief at the end. Rob will open it up to a few with time allowing. And just as we see on the screen there, the raise your hand icon will not be available for this session. It's strictly through the Q&A window. So at any point throughout the session, please feel encouraged to write any question you might have into that window. We also have the chat window available for all attendees to interact with one another, and for any support related queries, I'll be happy to address them there. Just know that Rob can only take questions from the Q&A window, so be sure to leave your question there if you want it addressed. Again, it is brief at the end, so if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time for this session, and if we don't get to your question, take that as encouragement to attend the insiders meeting when there's a much more focal point on answering questions. There's 45 minutes of questions rather for that session, so we look forward to seeing everyone on then. I think at that point, it covers off all the important details, so without further ado, I'll introduce Rob Roy.
Thanks, Zach, and welcome to everyone. If you are a first-time viewer to TradeFinder, welcome. And for those of you that have been with us for a long time, welcome to you as well. Welcome to everyone that's viewing on one of the social media platforms, live streaming, etc. We are happy to have everyone here with us tonight. As you can see from the background, I am back in the Dragon Capsule, as I call it, because I'm surrounded by screens, literally 5 screens around me, back from the mountains where it wasn't cold this time, but holy cow, they have some pollen going on up there. So my nose is happy to be back here. In our last recording over the weekend, the SPY update, we said bloodbath. And I think the last couple of days have borne that out. We'll talk about that a little bit more. For those of you that are new, here's how TradeFinder works. We talk about the markets, and we'll go through some international markets as well. So if you're viewing from around the world, welcome, and hopefully we hit your market. We try to rotate them around as time allows. We'll talk about any trade alerts that we may have closed recently for our alert subscribers at EWO Options, EWOTrader.com, if you'd like to learn more about that. Then we'll go through and review the case study considerations that we've identified in previous trade finders. We'll look for one this evening. And then, as Zach said, we'll open it up for Q&A at the end, time permitting. That's it. So let's go ahead and get started. And here's the chart of the market. And you can see there's that move to the downside, and all that's occurred over the last couple of trading days. As you can see from the 10-day moving average, if you watched anything that I've recorded in the past, you know my expression, no security in any time frame gets very far away from the 10-day moving average. So we are just a bit oversold at the close today, closing on the low of the day. We had a lot of earnings after hours, mostly good. Alphabet, so-so. Texas Instrument, good earnings, poor guidance. So we'll see how that all plays in. The futures are basically flat at this point in time. The Qs have moved back to where they closed, because after hours they went down a little bit and then came back to the upside. You can see better than average volume, but notice on the selling, the volume has declined a bit. So perhaps we're starting to get to the point where maybe the selling is ready to abate just a bit. A lot of people are watching the 200-day moving average. So I thought I would go ahead and show you that. So the 200-day moving average is way back up there near 450. So some pretty good separation there. And we're starting to gain. We're not quite that severe yet, but a little bit of separation between the 10-day and the 50-day moving average. So doesn't mean we can't go lower still, but we are balancing, if you will, on being a bit oversold. 420 being a key level of support. If we break that, you know, we've been talking about this for quite some time with the zigzag pattern. We feel like moving down towards that 400 level is warranted. So here's the big zigzag pattern to the downside that has a level actually breaking 400, going down to perhaps around 392, somewhere in that area. But again, at this point in time, just a bit oversold. We're at a point where if the market's going to try to make any sort of a bounce attempt, this is it. I think the bounce would be short-lived, but if it's going to happen, it's going to happen in the next trading day or two. So pretty rough with the markets at this point in time. If you look at the DMI, it's not going to give you much comfort, because you can see it just triggered today as far as there's some strength to this downward move. And so with that in mind, we could be in for some more pain moving to the downside. Now, one of the things that I found really interesting about today's sell-off, we had a little bit of a reversal day yesterday. I thought we might get a little follow through to that today. Didn't happen. And when you look at the 10-year, check that out. So we actually moved lower in yields today, and the market sold off big time. I don't think that's very positive, because up till now, the market has been kind of following along with what's gone on in yields. So for yields to move down and the market to move down like that, pretty significant. I think at this point, we probably should go ahead and take a look at the yield curve. And so if we look at the yield curve, that's steepening just a bit. There's towards the end. That's a positive as well. So why did the market sell off so hard? Is it the news out of China? We're worried about more lockdowns in China. Is it the commentary that came out of Russia that nuclear options are on the table from a spokesman there? Who knows? But certainly today's move to the downside follows in line with our bloodbath that we were talking about over last weekend's market update. Let's take a look at the moving averages on yields. You can see we broke the 10-day moving average, and we do have some pretty significant separation between the 10 and the 50-day moving averages. They're going to come back together, which means likely yields will pull back a little bit more, perhaps at least go sideways. But I think that a little bit more of a downside move in yields is the likely scenario, and close this gap between the 10-day moving average and the 50-day. It doesn't quite work the same way as when something is overbought or oversold with the distance from the 10-day moving average, where if the stock is overbought, it can go sideways and allow the 10-day moving average to catch up, or vice versa in the other direction. Normally, when the 10 and the 50 separate, there is a reversal. In other words, likely that yields do come back down, and that 10-day moving average that's kind of rolling over here a little bit comes back down more towards the 50-day. So it seems like we've seen the extent of yields for at least a little while moving significantly to the upside, a little bit vertical on the move, which also plays into the fact that perhaps we get a little bit of a pullback. But as I said, it didn't seem to matter to the markets today. Is it going to matter over the next few trading days? Well, I guess we'll wait and see. Pretty ugly day in the markets. Well, if we're going to look at yields, I want to look at the dollar. And this is surprising to me too. I don't think this is a positive. And you might be thinking, all you've been doing is talking about how you like a strong dollar, Rob. And you keep saying that you want the dollar to stay strong with everything that's going on. I do want the dollar to stay strong, but I don't want it to move vertical like that, because that means that something sinister globally is going on. And I'm happy that the dollar is still viewed as the currency of last resort and money is coming into the dollar. But the fact that all of a sudden it's turned vertical, it was already a little more vertical than I was comfortable with. I would much prefer to see the dollar just continue to slowly gain in the 45-degree angle that I talk about all the time. So it was a little vertical from that, but now it's gone straight up, which means that likely the dollar is going to come back down. So I'm a little concerned about what does that mean? What don't we know? That's usually what happens when the dollar goes rocketing like this, is there's something out there that we don't know, a black swan somewhere. We've talked in the past about China and Taiwan, et cetera. Is it the fact that there's concern about Russia actually moving towards nuclear weapons to end that war? I don't know, but I wanted to show you the fact that the dollar had gone vertically to the upside. It's overbought at this point in time. So, if you've watched me a lot, you feel like I might be flip-flopping here a little bit. I'm not. I'm still in favor of a strong dollar. I'm just concerned about what it means for the dollar to go so vertical like this. So to me, that's an issue that we're probably going to have to deal with in the not too distant future. We'll find out. Black swans don't stay black swans forever. We become known as far as what the issue is and what's causing this to happen. So we'll see how that plays out. I thought we'd go ahead and look, as we start looking at international markets, we might as well go ahead and look at oil and natural gas. I'm sure you guys are going to ask about that anyway. So let's take a look at those two. And so there's the chart of USO, still in this big symmetrical triangle. Looked like yesterday we were going to break out to the downside, right back into the triangle. So no breakout day, no follow through day, right back into the triangle. Oil is going to make a significant move here in the not too distant future. We look at the DMI. Now it's broken below 15 nicely, heading towards 13. That's why we look at the ADX as far as our breakouts of triangles. We have an entire portfolio at Elliott Wave Options devoted to triangles, and the ADX being low is one of them, because when the ADX gets really low, it's closer to the point where you're actually going to get a breakout rather than forming a larger triangle, which can be a negative when you create a triangle where you're buying a call and buying a put, especially the way we do them, where we put all the math in our favor to where the options will make money as fast as mathematically possible, but we're still buying both options. So theta decay is the enemy, time decay. And if you form a larger triangle, that just takes more time before the breakout. So a lower ADX means that you're likely to break out sooner rather than later. So I don't think we're gonna have to wait much longer. So again, we had the false breakout yesterday, right back into the point, but we're gonna make a significant move here sometime soon. So let's go ahead and look at natural gas as well. That's really in play with what's going on globally between Russia and the Ukraine, and a little stronger chart there, hanging in there pretty decently. Still in a wave 3. We haven't labeled a wave 4 yet. We look at the 10-day moving average on natural gas, just closed right on top of that 10-day moving average. So it looks like there's going to be an entry here. I'm waiting to send out another alert to our subscribers on natural gas. But at this point in time, that 10-day moving average is too far away from the 50-day. I like the consolidation here. It's letting the 50-day catch up a little bit. But as I said, with looking at the dollar, we need to have these two come together a little bit more here, interest rates, etc. And maybe natural gas comes down even a little bit more. But it's hard when the 4 hasn't labeled to put on an alert to the long side when there's that kind of separation between the 10 and the 50-day moving averages. All you have to do is go back and look at time, and you can see how close they follow each other. And when they get too far apart, and see how they come back together all the time. So there, here. Now we got a little bit below it, back to the upside there. And it's tempting to chase that, but you don't want to fall into FOMO, fear of missing out, which is what happened to a lot of people here on this gap to the upside. We talked about that last week, so I won't go through that again, but I thought I would update everybody on those. So let's look at some other markets here in the US first, and then we'll go to some international markets. Look at the Dow via the diamonds. A lot of people like to look at that, and you can see that a little bit better. That's not saying much, is it? A little bit better than the S&P as far as breaking to the downside, not quite down to the support level at 330. Is that a good thing or a bad thing? The fact that we're not down there yet like we are on the SPY back to 420. Wouldn't it have been interesting if the SPY would have hit 420 on 420 instead of 426? Anyway, coming down here towards the level of support at 330, not as far away from the 10-day moving average as we are on the SPY, but you can see that we have this wave 5 target down here somewhere between 315 and 310. Let's go ahead and look at the Qs as well. Talked about this numerous times. Again, I don't want to keep repeating myself for those of you that watch us all the time, but for those of you that are new, talked about how I feel like the Qs are going to underperform the rest of the market, the S&P and the Dow this year. even if we finish to the upside by the end of the year, still feel like the Qs are going to underperform with rising interest rates. That's how things usually work out. And you can see that pretty vertical move down, and we did close below those lows there at 320 on the Qs. A little bit of separation here from the 10-day moving average on the Qs, not quite as significant as on the SPY, but also not as significant of a gap between the 10 and the 50-day moving average there either. More of a methodical march down towards what is likely the low that's going to occur on the Qs down there around 290. It's just such a good pattern here, a 5-wave impulse pattern to the downside with that 61.8% wave 4 correction. Now, if you're looking for a little relief from the markets, the wave 5 is also at the 61.8% fib level. So the extension to the downside is there. So again, if we're going to bounce, we should bounce fairly soon. If we're not going to bounce, then watch out below. We're probably going to break all those support levels with the S&P, the Dow, and again, we close below with the Qs. But everybody knows that has watched any of my recordings as well, that one day doesn't mean anything. You have to have a second day, a follow through, a confirmation day. So if we close lower again tomorrow, then we're probably going straight down to that wave 5 target without a bounce. But if we can break back above 320, perhaps close the gap to the 10-day moving average, maybe we get a little bit of relief before moving lower. I could even envision a bounce back up and testing 340. We'll see how that plays out. But for now, pretty ugly day in the Qs. Really significant move to the downside on the Qs. Small caps. Did we do it? Did we break out of the bottom of that? We did. Out of the trading range that we've been in. Look at that. Close below 190. And again, looking forward, do we get a follow through day in this 2022 trading range? As you know, 2021 was a low of 210, a high of 230. And for 2022, the range has been 190 to 210, which you stayed in, and closed below it today. So do we get a follow through day? A little bit of separation there. You can see that the IWM very rarely gets very far away from the 10-day moving average. Look at that. It just doesn't do it. And so this, where we are on the close today, that's about as much separation as you ever get from the 10-day moving average on the IWM, the small cap. So perhaps they're giving us a little bit of a heads up that we might get a little bounce in the next day or two, likely tomorrow, because if we get a follow through day, same story applies. We're probably going all the way down to this wave 5 low around 175, but very significant that we broke 190 today. Would be more significant if we have a lower close tomorrow, giving us a confirmation day. So you know what to look for tomorrow. Bitcoin. And we broke that 40,000 level, and we tried to trade below. We traded below yesterday. We tried to close below it, but we were able to close back above it. And as you know, the good news is the 5-wave impulse pattern to the downside has been disqualified. So we're in corrective patterns now, but we did close below 40,000 today. So we'll be looking to see, do we get a follow through day there tomorrow? Tomorrow becomes a very interesting day as far as where the markets go over the next week or two. Do we bounce, or do we continue lower and it get really ugly? So can we get back above 40,000 on Bitcoin tomorrow, or do we get a follow through day and we're down to 36? 36 is the next level of support. You watch the videos, you know, 4,000 levels are the keys on Bitcoin. Every 4,000, there's a support or resistance level. We were up at 44, and then we had 48. And so if we break 36, we go down to 32. You can see that as a support level going back to last summer. So that's the next level if 36 doesn't hold. But right now, we're just wondering, do we get a follow through day tomorrow and come down to 36,000, or do we try to bounce right back above 40,000? Note that we are not oversold on Bitcoin. We actually traded above the 10-day moving average on the high today. So no oversold condition on Bitcoin. That's not a good thing if you're bullish on Bitcoin. We could easily come down to the 36,000 level. So again, every time I'm showing you one of these charts, it kind of depends on what happens tomorrow, whether we get a follow through day or a reversal day. moving into the end of the week. Looking at Australia, the XJO, and so much for that trying to break to new highs, really getting vertical to the downside there. The ASX looks like it needs to bounce. And see, the one thing I was concerned about was the separation. Not so much, it was a little bit overbought, but just to try to break to new all-time highs in this slightly overbought condition was concerning. So consolidating sideways would have been good. Little concern, or more concerned, about the separation between the 10 and the 50-day moving average. But look at this vertical move to the downside. That's too vertical. So we're also oversold on the ASX in Australia. So looking like we might want to try to bounce there. And we're at a pretty good level to try from. The support level right in this area here could give us a little bit of a bounce. So I'd say there's more signs looking for perhaps we do get a bounce tomorrow than not. But if we don't, man, it starts to get really ugly if we don't. But the uglier it gets, the more we're due for a bounce. So I don't know if that makes any sense. But if we go further away from the 10-day moving average, if we go more vertical in the moves, it's like stretching a rubber band. The further you stretch it, the more it snaps when you let go of it. And that's what's going to happen as we start to move away from the 10-day moving average. The further we go, the further you're stretching that rubber band as far as a snapback. You can see charts ugly everywhere. In the last SPY update, we added a couple new international markets, the UK, some others, based on suggestions from our YouTube viewers. And then some of you were upset because we took out the Nifty, which we show a lot. But in an effort to try to keep the videos from being too time consuming, we can't show everything every week. So we try to rotate it around. So for those of you that were asking, where's the Nifty? Here we are back again. And you can see hitting the 10-day moving average on the high, so nowhere near as oversold on the Nifty as we are in the US market. And here's that triangle pattern that still exists. So some sort of a significant breakout is coming on the Nifty here. And we're in a 5-wave impulse pattern. Look at that wave 4, right at the 61.8% level. So I'd say the odds are pretty good, whether we get a bounce back or not. Again, not being oversold here, that we're likely going down to that wave 5 low at some point. And it would make sense that if we break out of this triangle, that we probably head down there. So nothing too positive to say about the Nifty. But if there is something positive, even though we're in a 5-wave impulse pattern to the downside, again, if you've watched my videos, you know that when you see a triangle like this, regardless of the fact that Elliott would say the likely breakout is to the downside because it's in an impulse pattern, it's been my experience that when you have a well-formed, symmetrical, ascending or descending triangle, you have to respect the possibility of breaking in both directions. So we could break in either direction. So there is a possibility still that we break to the upside. So I just wanted to make everybody aware of that. And then let's look at the DAX. Oh my goodness, I'm almost nervous to show you what's going on there. Heading back down towards that wave 3 low. And if you've been with us for a while, I don't have to repeat this, you know that Elliott wave has been so spot on with the DAX for better than a year now. And here we are marching down towards a new wave 5 low. This wave 3 is relabeled 3 times from a 5 to a 3. So we're probably coming down here. That's really ugly for the German market. Little bit oversold today, but not significantly oversold. So, wow. Can you imagine the DAX down around 22? It's possible. The charts are looking like that could very well happen. Let's go ahead and update you on Brazil, because I did look at this in the last SPY update, and Brazil had a pretty decent looking chart. Let's see how they fared with what's gone on the past few days, and not so good. So this is taking everybody. Is pulling, you can see that we had the vertical move to the upside, came back down. I was concerned about this vertical move higher. that's what happens. That's why I don't like vertical moves. That looked awfully strong. Look how textbook this is. A doji at the top of a wave 3 after a vertical move, you're probably coming back down. And so we came down, we formed the wave 4. Now the positive on the Brazilian market is we're nearing a level of potential support there. So perhaps we can get a little bit of a bounce, and we are significantly oversold from the 10-day moving average there in Brazil. Now the 10 and the 50 are still close together, but the separation between where the market is and the 10-day moving average is in oversold condition. So that gives you a bit of a rundown of the international markets. And I thought I would go ahead and show you a recent alert that we closed for our alert subscribers at EWOtrader.com. This is on XHB, which is the home builders. You probably looked at the data where there was record home prices because the supply is coming down. And that's probably just because interest rates started going up. That's what usually ends a housing boom. When you start to get rates going up, you get one last flush. Anybody that's been waiting and has been resisting paying inflated prices say, if we don't buy now, we're never going to be able to because rates are going to the upside. So when rates start going up, you get that one last rush. And I think that's it. I think this is telling us that that's the end of the housing market boom that we've had. And so you can see that we sent this alert out at the very end of March. And here was the pattern where we had a 5-wave impulse pattern to the downside on the XHB. So this was on puts. You can see that we was the June 60 puts, and there was the move to the downside right down to our wave 5 target that exists. And look at the result of this. We generated an 80% gain in 6 days. 80% in 6 days. And that still shows you that when you buy long options, you have to be willing to let the options show a little bit of red at a time, because that's what happens with time decay. And so nearly 30% down, 28% down at one time, ended up with an 80% gain. All that happened in 6 days. So really nice move there. That's also what happens when you buy puts in a bearish market. Not only do you get the quick downside move, but you get the added movement of implied volatility into your options, really significant within puts. So I think that that's kind of telling us that this big old housing boom that we've been experiencing is probably over now with the move in rates to the upside. So that gives you a rundown of the international markets. Let's go ahead and look at our previous case study considerations. Again, welcome to everybody, all of you live streaming. Appreciate everybody viewing. And so we'll take a look at SIL, which is the miners for silver. We looked at this back on 3/22, and you can see here's the symmetrical triangle that we had here. And then we had a little bit of a larger triangle form. So that happens even when you have a lower ADX. So that's why we want the ADX to be low in the first place. And so there was the upward move, and then look at this big move to the downside. And if we look at the 10-day moving average, you can see that we are significantly oversold in silver. And then there's a gap right there. So it looks like we're probably going to get some sort of a bounce back in the SIL. Very oversold, also at a point of likely support. So if we're going to bounce, this is going to be it. Hershey Foods that we looked at back on 4/5, April 5th, and it was trading at 218 then. And this is something that I want to show you. This is an area where money was moving into food, the defensive sectors, etc. Even they're getting hit a little bit, and even they went down today. Now, there's an expression that a lot of old traders use, people that have been around. I don't mean old as far as age, but people that have been experienced, they've been around a while, is that the generals are the last to fall. In other words, those that have been outperforming or doing well, when they go down, you're nearing the end, or at least some sort of a tradable bounce. So if you go back here and look at the 20th there, we closed at 229. So if you didn't take your gains there, that's an 11-point move. If you didn't take your gains there, then you're looking at, all right, now we're coming back down towards this 30-day moving average. We've got some separation between the 10 and the 50-day moving average. So gap increasing or was increasing, now is coming back down together. We could move a little bit lower here. So, and this is one of those where you had a nice gain. If you didn't take it, then perhaps you're looking back and saying, I wish we would have. Do you want to wait till the wave 4 forms, or do you want to just go ahead and move out now? You can see that we're still a little bit above where we were back then. So we were at 218. Even with today's big drop, we're at 220. So you still have a gain there, especially with the added volatility in the market. So if you didn't get out, probably go ahead and take a small gain now. So we're going to go ahead and cross that one off the list, as that one should have been taken out. And then looking at MSM, and that one we looked at back on April 12th. And you can see the pattern that we had here, trying to break this area of resistance there. And looking at the DMI, looked like we had support to go ahead and do so. And then we're still pretty much at the same spot, but we have a different DMI. So we really haven't moved much. We were trading at 85 then, and we're trading at 84.58 now. So basically a small, tiny loss at this point. So that's not a negative. Still in a wave 3, we haven't labeled the wave 4. So you're thinking, well, you know, if we just go through here and consolidate a bit, perhaps we run up and hit that wave 5 target, and perhaps we do. But now we have the positive and the negative directional indicators and the ADX all right in the exact same spot. So that's giving you a neutral reading. So there's not the support system from the DMI telling you that we're likely to go up and hit that wave 5. So at this point, you would probably want to just say, hey, no harm, no foul. Let's just close that one out, and we'll reiterate and see what else is going on in the market. So I'm going to cross that one off too. Perhaps break even, perhaps a small, tiny loss on that one. But without the support of the DMI saying that we're going to break that high, I just think it makes more sense to let that go. And then another food, which is the SJM, JM Smuckers, and same scenario here, where we were about ready to go up and test some resistance, and we had support from the DMI. So we were trading at 142 then, and we went up and hit it. So we went all the way up to 145, and now we've come back down and we're trading at 139. So just a bit below where we were. Again, one of those that's kind of in a no harm, no foul type of scenario as far as the results, but we have a different DMI. We still have the positive directional indicator above the negative. There's still some separation here. And look, even with today's move, even with this move to the downside, the negative directional indicator went down. So this is one that I would say, hey, let's hang around and see what happens here. The ADX has moved or is above the positive directional indicator. That's not ideal, but it never got to 40. There is, again, still separation between the two. And I think it's telling that on a down day, the negative directional indicator went down. Had they come back up, and if that was looking at the same way that we had here with MSM, I'd say, hey, we probably just want to close that one out, let the market get this out of its system. But I think you hang around with this one. So we're going to keep this one viewed as still open as a case study consideration. One other thing that I wanted to show you before we start looking for a case study consideration for tonight is the transports, because we looked at that back here when they were significantly lower and the market hadn't followed through with that move down yet. So I thought it warranted taking another look at the transports, and there was the support there at 14,400. We bounced, the market bounced. This bounced more than the market did, but look at this. And you want something positive to show out of here, but it's just not there. So we're pretty close to the 61.8% retracement on the wave B, and then the C wave extension on the transports is all the way down at 13,254. That's not a positive for the markets at all. And you look at the 10-day moving average, and we're not that oversold from there. So it's looking like whatever bounce we may get out of the markets, we got to be really leery of it, because if the transports, if you're into Dow theory, and Dow theory is the transports lead the industrials or vice versa. So Dow theory basically is a combination of the transports and the industrials. If we're moving down here, I think you would say that looks awfully lot like the chart of the Dow that I showed that wasn't as significant as the SPY, wasn't quite at the lows yet. So do we get any sort of a bounce here? We're not oversold on the transports. As hard as that may be to believe, we're just not. And so the only thing that I can say that could be positive out of the transports is the fact that we are at a level of support here. And if we break that, then we're back down at those lows that we experienced in April. But if oil breaks to the downside out of that triangle and maybe gives a little bit of relief to the transports, perhaps that can be a positive for the market in general. But as I said, the next few trading days are going to tell us an awful lot as far as the markets. And oversold currently on the S&P. How long that lasts remains to be seen. So anyway, I thought it'd be interesting to take a look at the transports again. So let's go ahead and see if we can find a case study consideration for tonight. And if you're not familiar with this program, this is called Profit Source. To me, it's the best Elliott Wave software program that exists on the market. I've tried all the ones that I know to exist. Not saying I've tried them all, because maybe there's some I'm not aware of, but a lot of them are personal adaptations of Elliott Wave, and Profit Source is programmed directly with the algorithm that Ralph Nelson Elliott himself wrote. So nobody's own little quirks or whatever. It's just the pure Elliott Wave algorithm. And if you're an Elliott Wave options subscriber, the folks that created Profit Source, the hub organization, you can find out more about it at hubb.com, created these other pre-computed searches where all you have to do is make one click of a button and it brings up a search. Now you can go through and create searches of your own, customized searches. You can create trading plans, etc., all kinds of really cool things. And then it takes a little while for it to run. But if you have a pre-computed search, it's already done, and all you do is click on the button. Now, believe it or not, there's an impulse, bullish impulse result. And so this is Monster Beverage. So let's take a look and see what that looks like. And that's hung in there. We looked at that one, or it was on the list. Was it last week or the week before? It's hung in there pretty well. And so when some of the foods like Hershey's are not hanging in there as well, this one has. Still above the 10-day moving average. Good volume. Look at this volume over the last few days. So money's moving in here. The CCI is still strong and the DMI is still good. This could be a pretty good place to hide, if you will, with where the market is, except it's technically in a 5-wave impulse pattern to the downside. And so 69% is not disqualified yet. The 10-day moving average is crossed above the 30. That's a positive. And it looks like we're starting to get a pretty good separation on the DMI. So there's a possibility, basically, that this impulse pattern becomes disqualified, but it's not now. So when I see something like this, these are conflicting signals, right? The confirming indicators that we like are showing, hey, there's some strength here to the move. But the larger Elliott Wave pattern is saying, but we could still go lower. So which one wins out? Either one of them could, but when you don't have everything in alignment, that's when we say, hey, let's just watch it, learn from it, see what happens, but really not something that we would want to put any risk capital towards. So, as positive as it looks to have something above the 10-day moving average with what's occurred in the markets lately, and to have what appears to be a supportive DMI, you can see the positive directional indicator kind of ticked down a little bit, but so did the negative. ADX didn't turn down when it could have. So all that looks positive. Perhaps you could look at something along the lines of a sideways, maybe a butterfly or something in this large trading range here. It doesn't move a whole lot, so I don't know if there's enough premium in here to actually construct a butterfly and make it worthwhile, maybe with the volatility that's in the market. But usually when stocks go this kind of sideways, there's not enough premium to put on a sideways at the money butterfly. It's not my favorite strategy to do in general terms. I like it with our time strategy. We're going to be doing our time strategy mastery course for our time strategy subscribers here in the month of May. So pretty excited about that, where we're going to go deeper into it. But without the big drop, I'm not as much of a fan of a sideways butterfly. So let's go back and see if we can find something else. There is a corrective pattern here. Let's take a look at that on ODP. And well, that looks more interesting there. So the wave 5 was a 91% extension, so it didn't pass 100, which means we're likely to come back down towards this wave 4 here. So we're trading at 44, and there's a high likelihood. Look at the DMI, the negative directional indicator is crossing the positive. Let's see what CCI looks like. That's heading lower, not quite getting in the area, not quite to an extreme point that we hit back in November, but it is in an area that we found support from the CCI back in March. And then let's look at CMF. That's pretty ugly. So I would say that there's a pretty decent chance that ODP, let's see what the options look like on this, comes down to 42. Doesn't sound like a big move, $2, but for this stock, a $2 move is pretty decent. Look at the intraday volatility here. In the end, it doesn't move a whole lot, but it moves a lot intraday. Isn't that interesting that the bars are pretty large, even though in the end, you don't get a whole lot of movement, but there is a lot of support down there at that wave 4. So let's go ahead and take a quick look at the options here and see if there's any sort of decent options on ODP. Not super familiar with it. So let's see. Well, there's lots of choices, and the spreads they're not terribly wide considering what happened in the market today. So I would say, yeah, looking at this, by the way, the futures are now up 14 points. We've had a little bit of a run just since we started talking. So perhaps we do get that bounce tomorrow. The width of the spreads is not ideal, but I would say or suggest, you may have heard me talk about this before, that when you get this kind of volatility in the market, when the VIX was above 30 before, we talked about this, that spreads widen after the market closes, because when you have that kind of volatility, you can get extreme opens to the upside or the downside. And so what tends to happen is they widen the spread so the market makers don't get caught the next morning when you have an extreme high or extreme low opening. So the fact that they're not super wide, to me, suggests that that may just be that normal course of business, that the spreads widened a bit at the close, and then when the market opens tomorrow and starts trading, the spreads come in a little bit. And you know, they're going to be wider anyway with the VIX above 30, but looking at this, I would say that it's still tradable. And so I like that. So let's go ahead and we're going to put in, even though we may get a little bit of a bounce out of the markets tomorrow or the next couple of trading days, it does look like at some point we're going to hit that corrective level of 42. So down to 42, that's going to be our case study consideration for now. So we still have SIL, SJM, and now we have ODP. So those are the only ones that we have that would still be considered open considerations. And that's the difference between TradeFinder, right? We look for case study considerations, and then you're kind of on your own. For our alert subscribers at Elliott Wave Options, we send out alerts on entries, any adjustments, and exits. So we kind of take you by the hand and lead you from beginning to end on the alerts, rather than just saying, hey, that looks interesting, go do your thing. If you're interested in that, more interested, take a look at EWOtrader.com. All right, so with that, Zach, I'm going to go ahead and open it up to questions. So perhaps we have time for a few more than normal.
Absolutely. Thanks for that presentation, Rob. We've had tons of great questions and comments coming in both YouTube and Zoom. So we'll try and get through as many as we can with the remaining time.
Sounds good.
I saw Cindy had her hand up for a long duration of the presentation, but again, we unfortunately don't do voice questions for this session. I will pass through your question from the Q&A window, though, was to look at XLE.
Oh, okay. Makes a lot of sense with everything that's going on with energy. Let's just look at the energy ETF. Did it fill that gap? Boy, it gapped down yesterday. And well, it hit its wave 5 target. So it makes sense that we're going through this kind of stuff here. The support is pretty clear right there at the top of the 3 at 70. So we gapped down. We didn't quite fill the gap, but that's awfully close. The low there was 76.17. The high today was 75.80. So we didn't quite fill that gap. Look at the 10-day moving average, a little bit of separation there. So perhaps we bounced just a little bit higher and close that gap. Is that going to be suggestive of potentially a downside breakout of oil? We'll see how all that ties in, but perhaps a little bit more to the upside there to close that gap all the way and get back to the 10-day moving average. It doesn't have to. There's room to come to the downside here and hit 70. So this is a tough one as far as where it could go short term. We could come down easily to 70, or we could bounce back up towards that 10-day moving average. The separation between the 10 and the 50 is coming in a little bit, so that's not too significant. And on the close, there is a little separation from the 10-day moving average, so perhaps a little bit of a bounce there. This is one where there's resistance at 80, there's support at 70. That could be a consideration for a 70, 75, 80 butterfly as well. I think makes as much sense as anything else on the XLE. And the fact it's an ETF, normally not super. I mean, you can see what's happened lately, but in the past, it doesn't move a whole lot, right? Look at all these little tiny bars for over a year. And then recently, with things that have gone on with the war and oil, et cetera, it's been a little bit more volatile. But perhaps it calms down a little bit with that vertical move lower and we settle in here. I think that trade actually makes a bit of sense. A butterfly on the XLE, 70, 75, 80. Looks interesting.
Yes,
all right. Next.
Rob. So next up, Jordan from YouTube would like to look at the 20-year bonds, so TLT.
Boy, anything bond related is interesting right now, isn't it? So a little bit of a bounce higher here. On the 20-year. Now we can look at TBT too. Look at that doji sitting right on top of the 10-day moving average here. So let's see what happens. This is inverse, right? So this is the bond prices where TNX and others are looking at yields. So when we look to the upside here, we'll see if this moves. Yeah, something's going to happen tomorrow. That's a pretty tight doji sitting right on top of the 10-day moving average. So perhaps yields go down tomorrow and prices go back up. So perhaps this jumps up tomorrow. There is separation from the 10 and the 50-day here. So maybe we get a bit of a move back to the upside here in bond prices. And so we'll see how that plays out. But yeah, interesting.
All right, thanks, Robin. Next up, back over to Zoom. Curtis has a two-part question here. Can you explain why the Elliott wave pattern changed today for TZA, and how do you adjust your strategy when the Elliott wave patterns changed?
Well, the patterns change. It just follows along with what's going on, and it depends on what happens. So let's see what happened with TZA. Small cap. I really get nervous on these. You've heard me talk about this before. When you see it's a 3 times ETF, that's extra leverage. And the way they create that extra leverage is the use of futures. So you get a double whammy on time decay. Now, it hasn't been an issue lately because it's been so volatile, but these things tend to work their way lower because of that. See where it was, see how this is what happens to these kind of things because of all that additional time decay. They just slowly grind themselves lower. Well, not so much lately, right? Because you saw what happened with the IWM. We did break to the downside there. We have a little separation from the 10-day moving average. So perhaps we're a little bit overbought on that bears. So if that comes back down, then that means the IWM probably gets back above 190. I think those two things are likely to occur. This makes me less confident, or confidence, not the word, because I don't really have any confidence whether the IWM gives us a follow through day tomorrow or not. It's just viewpoint is that it's less likely that we get a follow through day to the downside on the IWM, with the fact that there's separation here as well. This is likely to come back down, and we're getting up here in this area of resistance. So I'd say this kind of bodes for a little bit of a bounce in the small caps and perhaps a little bit of a move back down in TZA. Now, the question was asked, what happens when the pattern changes, right? So here's the pattern before. Now, the wave 4 was 75%, right? So still qualified, but getting awfully close to that 78.6% level. So when we start looking, you can see that everything was staying in place, and then it moved out. So something, it looks like it's still moving in the same direction as what was forecast in the large pattern, right? So something the algorithm didn't like. And I don't that if you look at that mathematical algorithm, to me, it's looking at Beautiful Mind, where you have all the formulas and stuff. I feel like I'm pretty good at analyzing Elliott wave. Am I really good at the pure mathematical formula of Elliott wave? I'm not that great at math with that kind of stuff. So what exactly the algorithm didn't like to cause the pattern to change, I'm not sure. It looks like it was still moving in the same direction as the big impulse pattern. Perhaps it's this separation here that it didn't like. I'm not sure, but we are at a lot of resistance, and we're too overbought to break above 40, in my opinion, right now. If it did, it probably wouldn't hold. You've heard me talk about this before. When you break resistance and you're overbought, it usually doesn't hold. It comes back down. See Canada. In fact, I didn't look at Canada. So let's go ahead, and I'm going to bring the chart of Canada up real quick, Zach, before we get to the next question. And Canada, we talked about this. Man, it's amazing. The possibility of coming all the way down to 37. Holy cow, here we are. We didn't hold anywhere in this area that could have held in this 38 to 38.5 range. Went right through it like nothing, just like a warm knife through butter here. Yeah, a terrible analogy. It's so common. But we got a couple gaps here. So there's a gap, there's a gap. So perhaps Canada is awfully oversold. We're at an area where it's going to bounce. That looks like a pretty good trade to me. So I would suggest that if you're looking for something, a bounce out of Canada looks as good as anything. So I'm actually going to make a note of that. EWC moving back to the upside towards at least 39. I think that looks pretty good too. So that could be a case study consideration for you there, as well as ODP. All right, sorry, I didn't mean to deviate, Zach. I meant to show that chart before and I forgot.
No worries. Thanks, Rob. I will say the warm knife through butter was not too bad, but the stretchy rubber band definitely clicked better for me. That one was nice.
Okay.
So we have a question from Manuel from YouTube asking about RH, triangle breakout and retrace.
Love to hear people talking about triangles and retracements, etc. That's awesome. So let's take the moving averages off here. Look at that. Oh, doji today. There you go. That's probably why the question came up. So now we have a big descending triangle here, right? And so this is furnishings, if you're not familiar with. All right, so big move to the downside here on the lower highs. Really, really well-formed descending triangle. Good call on that. The ADX is not quite low enough yet, which is why it hasn't shown up on our screen. But that I want to, and I'm glad you brought this up. A triangle does not have to have a low ADX to break out. It's just one of the rules that we put in place, because larger triangles can form and the time decay starts to eat you up. That can happen at any time. It can happen even with a low ADX, but it's less likely to happen when the ADX is low. That's why it's one of our rules. But you look at this with a descending triangle here and a doji. Now they were talking about a triangle breakout and retracement. So I don't know if perhaps that's the triangle that was being referred to, that it broke to the downside and came back up towards the point, because there was a bit of a symmetrical triangle there. I assume that may have been where the question was coming from. And so the fact that it did retrace that means it's free to do whatever it wants. And what it did, what it wanted to do was form a larger triangle. So we've got this big old descending triangle now. And boy, it's going to be really interesting to see where that breaks out. It's a big one. Look at that. It's 120 points wide. The mouth of that triangle, that's going to be a big move. So look at that. Vertical move to the downside there. So if it breaks out, it's going to have some resistance here to the upside and Katie bar the door to the downside where we could go anywhere. So, wow, we'll see what ends up happening from there. And if my comment on the housing market is right, then that could be a downside breakout. But that's an extremely well-formed descending triangle. I like that for a strangle if you have a larger account, because it would be an expensive strangle at 320. And then we got the VIX so high. That's really expensive too. You'd almost be counting on a downside breakout. Otherwise, if it broke to the upside and the VIX came down, you could have a nice breakout and not make any money. So perhaps with second blush, just let it break out and then trade it directionally rather than trying to put a strangle on it. But that's a great looking descending triangle. Good pattern.
Absolutely.
Okay.
Yeah. Thanks for that, Rob.
Do a couple more real quick. I know we're at 10 o'clock, but let's get two more real fast.
Sounds good. I was going to say, Nicholas from Zoom asked about Tesla, and there's been tons of chatter amongst attendees from YouTube about Tesla as well.
Yeah, I can imagine. And boy, they're picking on Elon, right? Because they're saying that now they're concerned about, is he going to be able to focus as much of attention on Tesla because of the offer to buy Twitter, et cetera. And so that's played into it. Big, ugly down day today in Tesla. You look at the moving averages. So we broke the 50-day moving average significantly. The 10, 30, and 50 were all kind of there together. And the good news, if you're long Tesla, is that we're in an area where we could find some support. There's congestion in there from February and March when we were down here again. And now we have, based on the close, 121 point down day is pretty ugly on Tesla. That's oversold. Even if we traded a little lower earlier in the trading day or whatever, I would suggest that we're probably in a point where we could bounce. But the problem is, if we bounce, now we have all this resistance here because we were trying to hold this area of support right there at 1,000. So now 1,000 becomes resistance. And it's interesting in his effort to buy Twitter. Did that play into this, or was it just market conditions? Nobody knows, right? But if it was that, then that's an expensive purchase of Twitter, because he just lost a whole bunch of wealth with his move to the downside in Tesla today. But again, it's in an area where we could bounce. It's oversold. At least moving back up to the 50-day moving average makes sense. Testing 1,000 makes sense, and then see if it can bounce any further from there. But it's at an area of support, and perhaps Tesla kind of finds its range here and trades in between these levels, in between like 850 and 1,000, just to keep the numbers round, somewhere in that area. But yeah, pretty interesting day.
Yes, indeed. And you said you wanted to finish on one more, so this transitions well from Paul from Zoom. Fun cue for Rob. I shorted Twitter many months ago, made some good money so far. Moving forward, not sure what to do because markets appear to be heading down. But love Elon Musk, and I see him being a positive business influence for the company. Any thoughts?
I agree. If anybody can do anything with Twitter, it's him. I think everyone out there would agree that Twitter has been, under monetized, if you will. The board before had not done a very good job of monetizing Twitter. And so you can see we had a move back to the upside here. We came back down, we filled this gap. And so the fact that it's trading at 50, which is below, 54.20, here again, 420 with Elon, he loves doing that, is the price that he's wanting to take them private. And the fact that it's trading just below 50 tells you there's a little risk premium built in there that perhaps the deal doesn't go through? Does the government step in? Is there any trust stuff or any hurdles that the government throws at potentially the deal? The financing isn't as fully secured as he says, whatever, but there's a little bit of risk premium built in there that perhaps the deal couldn't go through. Otherwise, we'd be pegged. Sometimes you see a stock that gets bought out and it just trades in a straight line at the buyout price. Well, it should be up at 54.20. It's not. Why? Because again, there's a premium being built in that something could happen that the deal doesn't end up going through. But I do agree with the assertion there with Paul. I think you said it was Paul. If anybody can do anything with it, I think Elon can, as far as getting the full monetization out of it. It's a platform that a lot of people use. He loves it, and so we'll see what ends up happening with the deal. A little bit above the 10-day moving average here, so we kind of went vertical there. I think likely we're going to find some sort of a move back towards that 54.20 level, unless something starts to show up that could end the deal. Otherwise, we should be there, like we hit this high here, right in that area of 54.57. And that's what normally happens. So I would suggest that perhaps we close the 10-day moving average gap and then a slow rise back up and kind of peg itself around that 54.20 level until we find out if the deal is going to go through or not. Looks like what's going to happen. As far as this gap being closed, if that's why the question was asked, if the deal falls through, that gap gets closed, right? I mean, there's no question about that. I'm not telling you anything that anybody listening doesn't know, that if the deal falls through, that gap gets closed. But if the deal goes through, that gap could hold. He takes it private. That would be one of the few gaps that ends up not getting closed. And so I would suggest to you that we're not going to come down and fill that gap as long as the deal looks like it has a reasonable chance of getting done. So we'll find out in the not too distant future. But my best observations or whatever would be, maybe we test the 10-day moving average, maybe not. We filled the gap today. We drift back up towards 54.20. Thanks to everybody for watching. I'm glad we got a few more questions in than normal on TradeFinder. Hope you enjoyed this. And boy, as I said, tomorrow is going to be interesting to watch with the markets. Do we get any sort of bounce? Do we fall through the downside? We'll see what happens.